Hey, I'm Jonathan Wild, and we cover how to record preferred stock cash dividends. Preferred stock usually has all the same rights as common stock, plus a few extras. One of those extra rights is receiving dividends before any dividends are distributed to common stockholders. Another right that preferred stockholders sometimes have, but not always, is a cumulative dividend right. This means that preferred stockholders have the right to receive all current and prior period unpaid dividends before the corporation distributes anything to common stockholders. Any dividends not paid to preferred stockholders are called dividends in arrears. However, these unpaid dividends are not guaranteed to be paid, and they are not a liability to the corporation. It simply means that dividends in arrears must be paid to preferred stockholders before any dividends are paid to common stockholders. This will all make more sense with an example. Assume a corporation has 2,000 shares of $50 par value, 10% preferred stock outstanding. To compute the preferred dividend, we take the 2,000 shares, multiply it by the $50 par value, and multiply that by 10% or 0.10 to get a potential dividend of $10,000. It is a potential dividend as the corporation is not required to pay any dividend if the board of directors decides not to. Also, the company has common stock outstanding. Now assume the directors declare a dividend of $8,000 in year one. And let's run through two different scenarios. One where the preferred stock has a cumulative right, and in the other, no cumulative right. So if the preferred stock has a cumulative dividend right, the preferred stockholders would be paid $8,000 and the common stockholders would get zero. In addition, the preferred stockholders will now have dividends in arrears. To compute this, take the $10,000 of potential preferred dividends to preferred stockholders and subtract the $8,000 that was paid to get $2,000 of dividends in arrears. Alternatively, if the preferred stock was non-cumulative, preferred stockholders would still be paid $8,000 and the common stockholders would get zero. However, the difference is that non-cumulative preferred stockholders would not have any dividends in arrears. This will come into play in year two. So now, let's say in year two, the directors declare a dividend of $30,000. So first, if the preferred stock has a cumulative right, preferred stockholders are first paid their dividend in arrears of $2,000. Next, they receive their full $10,000 dividend for the year. After the prior dividend in arrears and current dividends are paid to preferred stockholders, common stockholders get what's left. To compute the amount paid to common stockholders, take the $30,000 of total dividends declared and subtract the $12,000 now paid to preferred stockholders. This gets $18,000 of dividends to common stockholders for year two. Alternatively, if the preferred stock was non-cumulative, preferred stockholders would be paid their full $10,000 dividend for that year. After that, common stockholders get what's left of the $30,000 declared. To compute what's left, take the $30,000 of total dividends declared, subtract the $10,000 paid to preferred stockholders to get $20,000 of dividends paid to common stockholders for year two. As you can see, dividends paid to preferred and common stockholders is affected by whether preferred stock is cumulative or non-cumulative.